For more on where stocks are likely heading from here, let's bring in our headliner today, Keith Banks, Vice Chairman at Bank of America and Head of the Investment Solutions Group. Good to see you again. Welcome back.
Great to be here, Scott. Thank you.
You heard what Steve said. People are pessimistic. Are you?
We're not pessimistic. We had said that when the S&P gets around that 4,400 level, which we expected it to achieve, and it has, that the market would get a little tired, and you need some additional catalysts to get it higher. We call it a kind of a grinded out market from here. Could it go higher? Will it go higher? We think it will. Could it approach 4,600? Maybe on the high end, but what it's going to take is, I think a continuation of what we're seeing, which is great earnings coming through. And your discussion just before obviously highlights the importance of that. But, if you look at the companies that have reported to date, the numbers have been great. 85% have beat earnings. 83% have beat revenues, and 73% have beat both. And so we're looking at numbers continually being raised higher. And the other thing that's interesting, Scott, is we essentially pulled the 2022 numbers into 2021. Originally, people were talking about 200, 205 for next year. That looks like it'll be this year's number. And then you can see numbers next year maybe as high as 220. I know Tom Lee was talking even higher numbers yesterday on your show. And I think as we go through the rest of this year and you begin to more fully discount 2022 earnings, that's what can help you drag the market higher from these levels.
Yeah, Tom Lee's got 4,600 on the S&P. But you think we could legitimately do another 5% between now and the end of the year? I mean, given everything that's going on with, the Fed's going to talk this week, Jackson Hole's around the corner, Delta variants out there and making people nervous, masks mandates, or at least suggestions are being discussed again.
Yeah, I think that would be the high end of a potential range upward. But if you step back and all that's going on, but I think the good news with that is it kind of flushes euphoria out of the market, right? One of the things you always worry about is the market getting euphoric. I don't think it is for the reasons you just cited. People are very focused on, they're saying has the growth rate peaked? We're not looking at the second derivative. We're more focused on the level of earnings growth. And the level of earnings growth is going to stay above average. We think not only the rest of this year, but into next year, that's going to be a positive catalyst. The cost of capital is extremely low. We've got 300 basis point negative real rates right now at a time when the economy is going to grow over 10% in nominal terms. Companies are borrowing at very low rates. And then they're reinvesting. That in turn is helping earnings. So there's a number of factors that we think can balance out some of the concerns out there. As I said, if we go higher, we kind of grind it out. We've been articulating a strategy of balance, and your conversation before really gets to it, right? So we've been saying it's not growth or value, it's growth and value. And what's interesting, if you look at the year-to-date total returns, they're almost exactly the same. I think the Russell 1000 growth is up 18.3 and the Russell 1000 value maybe 17.5. So we're saying maintain a balance with respect to growth and value, balance across capitalization, and even balance from a geographic standpoint. This way you can absorb the yings and the yangs that are going to happen based upon near-term developments, which we see continuing throughout the rest of this year.
But it sounds like as well, you don't think that the good times, so to speak, are fully baked into this market yet.
We don't think so. I mean, last time I was on your show, Scott, we talked about the fact that it was kind of a boring answer, right? We thought, number one, the economy would continue to surprise on the upside. The only reason growth rates have come down is not because demand is waning, it's because the demand is outstripping the ability to supply that demand. So that tells us the cycle gets elongated. So we still feel good about the economy overall. And the other part of the story, which we think is very much valid, is that the analysts have been playing catch up all the way through this. And after this series of earnings releases, we think they're going to raise numbers again and raise it right into 2022 with rates staying down, with the Fed probably not tapering until sometime in early next year and rates not rising until probably sometime in 2023. Again, not a rocket lift off from here, but to grind it out, move it higher into the end of this year, and then with some very robust numbers next year, hopefully that gives you some more tailwinds to get the market going from there.